All right, let's dive right into this explainer and decode Meta's fascinating 2025 financial performance. What we're looking at today is a phenomenal story of massive present-day dominance balancing out incredibly expensive future bets. If you really want to understand how modern tech giants fund the future while you scroll in the present, this is absolutely the perfect case study.
Here is our roadmap for today. We're going to cover the $200 billion milestone, the family of apps engine, the Reality Labs money pit, the massive doubling down on infrastructure, and finally, the tax bill plot twist.
Section 1. The 200 billion milestone and Meta's unprecedented scale. Let's start right at the top. We're talking about $297 billion. That staggering figure is Meta's total revenue for the entire year of 2025. Just to put that into perspective, that's a massive 22% increase from 2024. I mean, growing by nearly a quarter when you're already pulling in over $160 billion, that's an absolute feat of scale. It's literally like bolting an entirely new Fortune 500 company onto your balance sheet in a single year.
Section 2. The family of apps engine, and exactly how the money was made.
So where is all this cash actually coming from? The core engine driving this revenue is a compounding trifecta of growth. Think about it. Every time you scrolled in 2025, you were part of an ecosystem that grew 7% to reach a whopping 3.58 billion daily active people. But there weren't just more people hanging out. Ads were delivered 12% more frequently. And here is the real kicker. Advertisers paid 9% more for every single one of those impressions. More users seeing more ads at higher prices.
And because of that incredible volume and sheer pricing power, the Family of Apps segment pushed its total revenue to nearly $199 billion, generating a jaw-dropping $102.47 billion in pure operating income. This is the ultimate cash cow, guys. It is the flawless engine that keeps the entire Meta ecosystem running.
Section 3. The Reality Labs money pit and funding the future.
Because, there's a second, drastically different reality to Meta's financial story. While the family of apps minted over $100 billion in profit, Reality Labs, which is their massive bet on the metaverse and hardware, well, it widened its operating loss to $19.19 billion. Sure, it brought in a couple billion in revenue, but that is completely dwarfed by the nearly $20 billion it cost to actually run the segment. Basically, the highly profitable present is funding a very, very expensive future. Which brings us to Section 4. Doubling down on infrastructure and the physical cost of it all.
The virtual world isn't their only expensive bet right now. Meta's capital expenditures, heavily driven by infrastructure, practically doubled. We're talking rocketing from $39.23 billion in 2024 to an eye-watering $72.22 billion in 2025. You simply cannot support massive AI workloads and 3.5 billion daily users without a colossal physical footprint of servers and data centers. It's just a reality.
Now, this intense spending spree, paired with higher pay for top technical talent and ongoing legal costs, pushed Meta's total operating expenses up 24% to over $117 billion. But here's why this really matters. Despite spending like there's no tomorrow, Meta kept its operating margin virtually flat at 41%. Their revenue growth is just so incredibly strong that it's completely absorbing these massive new costs without breaking a sweat.
Section 5. The tax bill plot twist and why net income actually fell.
Okay, so here's where the story takes a sudden, unexpected turn. Think about all the facts we've just laid out. Revenue is up 22%. Operating income jumped 20%. Free cash flow is absolutely massive. With all these arrows aggressively pointing up, you would totally expect a record-breaking bottom line, right? Yet, net income actually fell 3% to $60.46 billion. So what gives? Why did net income drop while everything else soared?
Well, the culprit is a recently implemented law ironically named the One Big Beautiful Bill Act. And, as it turns out, it wasn't so beautiful for Meta. Because of this act, the company had to swallow a surprise, one-time, non-cash income tax charge of almost $16 billion in the third quarter. That is a massive valuation allowance ripped right out of their net income.
This single piece of legislation completely skewed Meta's optics for the year. Think about this. If you exclude that $16 billion one-time hit, Meta's effective tax rate would have been a very lean 13%. But because they had to report the charge, their effective tax rate officially skyrocketed to 30%, which obviously dragged down the whole year-over-year net income comparison.
So what does this all mean for us? Meta's core ad engine is an unstoppable force right now, flawlessly executing on user growth and pricing power. But with physical infrastructure costs doubling to over $70 billion, Reality Labs burning $20 billion a year, and surprise multi-billion-dollar taxes just popping up, we have to ask the big question. Can the massive profits of today's scrolling realistically continue to fund the virtual world of tomorrow? It is the ultimate high-wire act. Thanks so much for joining this explainer, and we'll catch you next time.